moderating the environment to make sure that you have minimum noise. Well, sorry for that. I was saying previously you were looking at the overview of the real estate market in our country, Kenya. And today we will check into the various types or forms of ownership of real estate properties. And we said that a real estate involves also the rights and the privileges. You could not be the owner or the sole owner, but through the rights that you've been given or the privileges. Either is a mortgage that you are servicing, either you are on a lease, either you are on a rental property, where the relationship is that of landlord versus tenant, and you agreed on the amount that you'll be paying for your stay in that particular piece of property or space. So today I want us to go through the types of property ownership in the real estate market. And there are several types of property ownership to choose from. And each, of course, comes with its benefits and drawbacks, or its merits and demerits. So before you enter into any agreement, I normally advise people, before you enter into an agreement for a real estate asset, it's very important to be fully informed about the underlying legal, practical implications, tax, name them, before you own that particular property. Some forms of ownership will give you advantages than others, and that is why we need to go through the types of ownership. So when looking to purchase a commercial property, it will be always wise to consult with a lawyer, not only lawyers specializing in the properties, but also practicing in the country where the property is located. You've had cases where people go to other countries or overseas and try to get a property there, thinking that either that market is hot and chances of investing there and getting back the investment at the minimum period is granted. So different types of ownership may be preferential. Some for commercial, others for residential. It depends on what kind of property you want to own. So I've summarized the ownership into 7 categories. And the first 4, this is what we'll call more or less the traditional ones. So when we talk of sole ownership, it's like sole proprietorship business. So in this scenario, the full ownership of the real estate asset will belong to a single individual. That's why we are talking of sole ownership. Sole means one. And the biggest appeal of this kind of ownership is because of the decision making. So when you are the individual decision maker about your property, how best to use it, when to sell, you don't need any approval or any other party being the owner. But these have changed. In this country, for example, if you own a property and you are the sole owner, let's say you have an acre of land, but you are a father, to mean you are married, you got a spouse, and you have children. It is highly unlikely that you will walk to the lands office and do a transfer of that land ownership to another person, where you want to sell your property and now get money, maybe to invest elsewhere. You cannot, it's not easy. The way our system is running, after realizing that the masculine gender are taking advantage of their families, your father can sell the piece of property where you are living na amue aende akakule raha Mombasa na hiyo pesa. There isn't much that you could do. But through the provincial administration, they have established what we call the land boards. And what normally happens in the land board, there is no property that can be transacted now in Kenya without having passed through the land board. And the need for this is to ensure that no one will be suffering after you dispose of that property. So if you have children who have attained majority years, who are 18 and above, of course, they need to consent that they have agreed their father to dispose of that property. Now it becomes a tussle if they are below 18 years, because the justification has to be given by the mother. So it becomes very hard. You cannot sell. And the land board has been devolved to the lowest level. So the mzee wa mtaa will sit in that board. The owners of that particular area, you are going to have two individuals who are nominated to be sitting in the board. Do you know what that means? It means if the chief, let's say, doesn't know where your property is lying, the mzee wa kijiji who has been nominated to be sitting in the land board will be knowing. So there is no way that we are going to lose the track of the history of that land. Was it transferred from your, is it by inheritance and you want to take the advantage of that? Wherever, do you have a family? Is anyone going to suffer when you sell that property and the like? So I think our land board are doing quite a commendable job. So even if you are talking of if you are sole owner, you have the decision, it is not cast on stone. You have to go through the authorities for you to be allowed to sell or to convert or sell that title to another person. So a major drawback of sole ownership is the complexity when it comes now to the property owners' heirs, because they have to clear you for you to be able to transfer the title. So a sole owner cannot be seen as the best form of owning a property. Well, the process could seem simple, but it's a costly affair. Before the name changes from ABC to XYZ, you will have taken some time. And it is deliberate and it involves some cost, because when you are transferring the property, depending on where it is lying, there are those capital gains tax that you need to pay. The buyer needs to meet the stamp duty, and the title cannot be transferred until this all is cleared. Sole ownership is commonly used for multi-family businesses or rentals. I have a piece of land, hata kama niliwachiwa na baba yangu, I decide to put some rentals, duplexes, triplexes, name them. 1 bedroom, yeah, 1 a bed sitter. I can decide to do the single units and the toilets are outside, the ablution block is outside, etc. I may also decide to convert it into a small retail property where I open a hardware, I start selling my own merchandise, etc. The second form is joint tenancy, and just to bring you abreast before you go into the real stuff. Now, with joint tenancy, 2 or more tenants own equal shares in the property. So the tenants are entitled to equal rights. So the income that the property is generating is benefiting or is shared amongst the owners. That's what we mean by joint tenancy. So a joint tenancy is one of the most common types of ownership, especially by the old wazaes. And many buildings in Nairobi are owned by these wazaes. They decided to take the simplest step, sold their coffee, sold their tea, and they came to Nairobi, commingled their funds, and they went ahead and acquired the properties. Right now, very few individuals own properties in this town. So one of the most important aspects of joint tenancy agreement is that there is right of survivorship. That's the only advantage, which means that if one of the tenants die, the ownership will be passed on to the surviving tenants. Unlike in the other cases where the ownership is not easily transferable. So in order to enter into a joint tenancy agreement, the property conveyance or title deeds need to specifically state that it was a joint tenancy and therefore there is a right of survivorship. If the deed or if the agreement that you people came together and agreed on joint tenancy, if the agreement does not state the clause of the right of survivorship, it really becomes very hard. So joint tenancies also come with a number of drawbacks or disadvantages, which can add a certain element of risk. A good example is if one tenant, let's say, had gone to a bank and gotten a loan, and they are defaulting on that loan, the bank can come, or the creditor whose debt is outstanding may come and collect their debt in form of the property owned there by joint tenancy. That's the only complication. So joint tenancy also have tax consequences. Because it's been used as an avenue of trying to evade tax, the government has also tried to close in and ensure that that loophole is closed. So we have a lot of tax that will go into converting sole ownership or a title into a joint tenancy. And of course, we can say that in this form of ownership, tenants are liable for their share of property. Once you join in mute, when you join in mute, you won't be useful if you are inside there and you are the one who is making the Evelyn, mute yourself. It's very easy to know those people who have joined late. But our climate will be, once you join, mute yourself. If you need to interject and ask a question, I've said we make use of the 3 buttons on the bottom of the, or depending on the device, could be top, could be bottom. Kindly make use of the chat button. So I was trying to take you through the basic or the traditional forms of ownership in Kenya before we come to the legal ones. And I've talked about the sole ownership and the joint tenancy. The third one is the tenancy in common. And this is where the property is owned by 2 or more persons at the same time. So this type of ownership, however, can be split into different percentages depending on the owner's equity. For example, if the property is worth 10 million, I could give 5 million, another person gives 1 million, another 3, another 2, as long as it's documented. In this form of ownership, unlike the joint tenancy where we've said that you can enjoy the survivorship rights are not easy under tenancy in common. So in the event of death, the deceased share is acquired by the beneficiary or heirs, who must enter into the tenancy in common with the existing tenants. That means you are replacing your father or the former owner if it was a mother. So a tenancy in common is another pretty popular type of commercial property or land ownership in this country. And if we look at where do they meet, or what, if you are asked what is the difference now between the tenancy in common and the joint tenancy. At a glance, they look similar, isn't it? But they differ in some ways. So you can see in both scenarios, the asset is co-owned by two or more parties. But in a joint tenancy, however, we do not include in joint tenancy, we have the rights of survivorship, but it is missing in the tenancy in common. So that is one of the differences. If you look further, a tenancy in common does not provide equal use or right, which means there is no equal income. Unlike in the joint tenancy, we've said you construct those rental houses. When the rental income streams in, you co-share. But you said in the tenancy in common, you could be having different share rights. So you could be owning the property by half, another person by a quarter, another one an eighth, etc. Then the last one is tenants by the entirety. And when we are talking of tenants by entirety, it refers to the form of property ownership in which a wife and a husband owns the property in equal shares. So the income that is generated by it will be co-owned. If you recall, we have Suraya. You know of Suraya? Owned by Susan, the wife, and Moraya, the husband. We also had the Kongo Gatabaki, where the husband was owning the land and the wife was developing. So when we are talking of the tenants by entirety, we are talking of co-ownership between the husband and the wife. So the advantage of this type of ownership is that it has an automatic right of survivorship. That is if you love your husband or if you love your wife. Because if either dies, the title will be transferred to the existing spouse. So if the couple divorces, it brings in a challenge. What do you think will happen? You are saying it is the best, but what will happen if the couple divorces? What do you think should happen? If they divorce, we are co-owning a property. Kibibi?
They should share the property. They divide by half.
Then, of course, the property was owned by half. It's only that it was not documented. The title was bearing the two names. The title had Anne Wanjiro and John Kamau. So what will happen if they divorce? It takes some time for the divorce to be actualized in this country, isn't it? The court will give you 7 years. So awaiting 7 years, what do you think? How would you advise this couple? Kibibi, I had called your name. Are you in there? Evelyn Duarte. Evelyn. Look at what I've indicated above there as the forms of ownership. Which one do you think will suit Wanjiro and Kamau as they process their divorce? Even without saying, the two owners will automatically become tenants in common, isn't it? Because this property was attracting an income, which means as we await for the divorce papers to be processed, we'll be tenants in common. Now, the biggest disadvantage or drawback of this tenancy is that both spouses must agree to sell the property. It could be perceived as a benefit because if the wife and the husband are owning a property, it means that the husband cannot sell without the consent of the wife. So I think to bring the families together is a benefit. But if these people came together to run this as a business, and we will be guided here by the entity concept, where the business is deemed to be separate from its owners, then there will be a big challenge. Others, we can say that the property is automatically protected from unauthorized sale, right? So that's where we are. I want us now to come to the today's. I just needed to bring you to speed on the forms of, or the conventional forms of ownership. Yes, I was on mute deliberately. I was sorting out an issue. So thank you for that. So today I want us to look at the legal domains. So it was good to have the understanding of the conventional ownership. So we'll be looking at the, I need not repeat on the ownership by sole proprietorship. I can also see we got the partnerships, or what we were calling LLPs. We have the LLCs, we have the corporation. So what is missing here is the owning through the trust. And basically, when we are talking of the trust, this is where, or a scenario where a trustee is designated to manage the real estate on behalf of the owners. So we'll be coming to the real estate investment trust and see how they are administered later on. By registration, we know that a trust belongs to the community and it is not supposed to make profit. So that's why I've deliberately left it in this particular classification. But we do have real estate investment trusts that are formed by big corporations and designate investment managers to run them on their behalf. So at the end of the day, you're expected to have understood these different forms. I've said sole proprietorship, I've covered that. Any concern on the other end? And I've said that a sole proprietor, they have an unlimited liability. But this may not be the ideal ownership form of real estate, especially as an investment item, because the sophistication will come in when we need to either raise capital, or there is an underlying liability, or we want to diversify. But apparently this is the easiest form of ownership of property in Kenya. If you are looking into speculative nature of ownership, then sole proprietorship will do you good. You identify a land somewhere in Kitengela, is going for 450,000. You have that money, you go meet the owner, willing buyer, willing seller, you transact. Holding all the factors constant, assuming the wife and the children would give you a problem, they transfer the title into your name. You are there waiting for the property to increase in price, and then you sell. So for speculative nature, you can go the sole proprietorship way. But as businessmen, we are looking into, you are buying, you want to invest in that property. So you are not buying for purposes of speculation. You buy today, tomorrow you want to approach your financial institution, give you some mortgage, you come and develop some flats and you start selling. So that is why we are saying you'll be restricted on raising either the capital or also being able to cushion yourself against the liability that might come from it, because it is unlimited. So that is sole proprietorship. Now we go to partnership. And the reason why I'm taking you through the ownership is because in addition to owning, there are areas, or there are, I can say, there is a what we call the pass-through taxation, where you can enjoy the tax benefit if you consume a product under one form instead of another. There are those tax advantages that you might enjoy. For example, for the partnership, we have what we call the pass-through taxation. But when you go to the LLC, the limited liability companies, the taxes are more, because each person will be expected to pay their own taxes. So a general partnership is ownership entity, of course, between 2 to 20 people. Now, each member is a general partner, as the word goes, to mean they are going to share in everything. The management responsibility, They are going to share into the liability. They are going to share into the capitation or contributing the capital or the shareholders' equity. These people are going to share everything. Now, as I have said, a general partnership is a pass-through tax entity. Reason being, the body in itself is not recognized as a legal person, and therefore it does not command any tax in our tax regulatory aspects. So what will be happening is everyone will be filing their income tax as normal. And we know that this is one of the merits of using such vehicles to own a property. You evade tax, not avoid, you evade. So tax evasion is legal, tax avoidance is illegal. If you are avoiding, you are a criminal. But if you are evading, then it means you are a citizen of good standing. You know what can pinch, and therefore you avoid it. So the partnership files a tax return as a reporting function only. It's not for any gains to the government. So the significant disadvantage of running a general partnership is that each partner will have unlimited liability for any legal financial responsibility of the partnership. That's a challenge. You mess up, all of us sink. If you do a decision blunder as a manager, all of us are going to sink. So each partner operates as an agent. So they carry their business on their shoulders. So if anything happens, or if there are funny dealings where the business is exposed to what we call financial risk, then it will hit all the partners. So the title to the property is held in the name of the partnership, and this is just a business name. And this may become an issue during liquidation, simply because if we report, for example, if one of the partners dies, it becomes very hard trying to now delete this partner, especially where the partnership deed had not provided for the beneficiary or someone who can be incorporated. So general partnership has a finite life, to mean we know when it will end. So when you are doing the partnership deed, you have to indicate that, let's say in case one of the partners is deceased, you are going to terminate for you to be able to pay the proceeds of the business then. If someone is incapacitated, let's say they are involved in an accident and they become disabled, or some even withdraws, they see that the partnership is not assisting them in making any financial progress, then the partnership agreement should specify if this is the case. Those are the general partnerships. Now, they are not recommended for groups of individuals that are seeking to form a business entity because of the unlimited liability of each partner. Now, you see, if you are not responsible and then your irresponsibility affects the other partners, that will not be a good vehicle. Then we come to the next investment vehicle, which is a limited partnership. Now, a limited partnership is a legal ownership entity, and we know that limited businesses, any limited business will be registered with the registrar of companies. So when we are talking of a limited partnership, this is a legal person. A legal person to mean you can sue, they can be sued. They have the foundations, the responsibilities of each partner is known, what each member is supposed to deliver is known, what capital they are supposed to present is known. So a key feature of the limited partnership is having two different class of partners. We got what we call the general partners, and we have what we call the real partners. So the general partners in the limited partnership are responsible for the business management. and they are essential in the same legal position as the partners in general partnership. So they assume unlimited legal and financial liability, like in the general partnership. So the general partners will make decisions when to sell, when to process loans, or when to get loans, and so on. In contrast, the limited partners are passive. So they will not be participating in the day-to-day operations of the business, and therefore their liability are also limited. So a limited partner is like a shareholder in a corporation. Once you purchase shares of Safaricom, do you want to know what happened in Safaricom day in, day out? No. You've invested in that company. So even your liabilities are also limited. So limited partners, like shareholders in a corporation, they are only liable for the money they have at risk. In other words, we are saying that they have limited liability, unlike the general partners who are carrying the weight of the partnership on their shoulders. Now, there can be conflict of interest between the general and the limited because decisions on when to sell the property, maybe we have the tax consequences, or they were engaged in a particular activity that has made them be penalized high, will of course have the conflict of interest. So a limited partnership is also a pass-through tax entity, to mean that they are doing this as a vehicle of evading tax, which is much allowed. As with general partnership, the partnership files a tax return, but all income, gains, and losses from the operations are reported on the individual partners' tax returns. So any cash distribution to the partners without being taxed at the distribution time is the key thing. So like general partnerships also, the title of the property will be held by the limited partnership. Each partner will own an interest in the partnership, but not in the property itself. Kindly note that the property will be under the name of the partnership. So shall you want to sell, it must be postulated in the partnership agreement that members, let's say 2/3, and you have to observe the voting pattern in either an AGM or a special general meeting where you are agreeing to sell. But remember, the name of the property is under the name of the partnership. No individuals are listed here as owners. So this poses a great danger when it comes now to liquidation. Because in case you lose one of the partners, or there are challenges that are hitting the businesses and the business is plummeting, then we are going to have now the challenge coming in because of the two categories of the partners. We got the general and we got the limited. And that's why I was alluding earlier, conflict of interest now brings issue. And we may find in most occasions, these people end up disposing the property, not at the prevailing market rate, but at what they are going to agree in the AGMs or the special general meetings. Now, limited partnerships have also a finite life. You see, when you form a legal person, they don't die. If you register a company with the registrar of companies, we expect that is a legal person. And unlike a natural person who can die, legal entities don't die. You will die and leave the registered company operating unless you start the process of cessation. But as long as it was registered, it will continue existing. And that's why we say that they are going concern. We expect that they'll continue doing so to an indefinite future. So limited partnerships can be effectively used for real estate investment, where one general partner will be used to register and scout for the projects of that particular partnership. But when it comes now to the sharing of the equity, this is when now we will know the right or the rightful owners, or what we are calling the limited partnerships. Any question? So that's the difference between the partnership general and the limited. Now we come to a limited liability partnership. General was not registered. It was just a business name. Limited liability was a registered business. So it was a legal person. Now we come now to the limited liability partnerships. Now a limited liability partnership is a legal ownership regulated by the state. It will have a number of limited partners with limited liability. And this one is normally used by the, you will find like law firms or the, let's say the professional bodies. Like for example, ISPAC. We have the Association of Kenya, we have the Association of Kenya Engineers, we have the Association of Kenya Manufacturers. So like other partnership entities, I have a lot of noise in the background for obvious reasons. Abuire, how are you?
I'm fine.
You are interrupting my class.
Hi.
Yeah, you're supposed to be on mute. Sorry for that. So we go on. So I was saying bodies like the lawyers, we have the accountants, architects, engineers, they will normally form limited liability partners. To mean, in the formation document, the registration will be merely to avoid the fees of if you are to go as an individual. But when it comes to the operations, each and every person will be doing their own things. So as a general partnership, each partner is limited or has a limited liability, and they are responsible for their business management. So the extent of limited liability may vary from one country to another, but typically each partner is liable financially for only their own investment. And therefore, we cannot hold one accountable for a mess that was done by another partner. As with other types of partnerships that we have discussed, now the general and the limited, this partnership files tax return as reporting function only. So there is also a tax pass-through. So all income, gains, and losses from the operations are reported on the individual partner's tax returns. And most partnerships are that way by formation. So as such, distribution goes to the partners without being taxed, and then they are going to reflect that on their income tax, or when they are filing for their income tax. So the title of the property is held in the name of the limited liability. So each partner will just own some interest in the partnership, but not in the property. So again, know that the name of the partnership will be bearing on all the title deeds that are owned by this particular limited liability partnership. I don't know whether that will be an advantage or a disadvantage, because it becomes an issue during liquidation. Well, no property can be sold without your consent, but again, it becomes an issue when you need to liquidate the property. So unlike typical general or limited liability, there is a note before there that a limited liability has no definite term. So remember, we said that the general partnership has a lifespan. In case of death, disability, or in case of incapacitation of one of the partners, they can decide on whether to dissolve. The same case to liability. But the thing comes to limited partner. But for the limited liability partnership, it is indefinite. So it will continue in operation. So the death or disability of a partner will not necessarily terminate the partnership. And therefore, we can say, like a corporation, then this becomes a better vehicle. So if you are to choose between general, limited partnership, and limited liability, then in this category, limited liability outstands the others. That is in the category of partnership. Now we come to the companies. And in the companies, you have the limited liability company, which is relatively new in the industry. This is the time now we are accepting the LLC. We used to have the private limited companies. But an LLC offers nearly every advantage of a limited liability partnership, especially in regard to the limited liability partners. It also has the advantage of management flexibility of allowing some members to be passive investors. You need not dedicate your full time and resources into the partnership. So you can just come, hold some interest, and leave. Leave the other parties to do the business for you. Now we have two types of LLCs. We have the member managed and we have the manager managed. If you decide to run your own liability company, it will be member managed. If you go ahead and employ a manager or a specialist in the area, let's say a real estate expert, to do the investment in the real estate properties for you, then whatever you will be doing will be manager managed. You've seen companies like Llc. We have companies like Frank and Freight. These are managers. So what normally happens, you are the investor, you acquire a property. Let's say, for example, Delta Towers. You go ahead and approach the Frank and Freight and tell them, I want you to manage my property. You have another property in town, let's say Kagen Towers. You give Llc to manage it for you. So you can see the difference. Where you are doing it yourself, it is member managed. But where it is being done by a professional, real estate professionals, then it will be manager managed. Now, in a manager managed LLC or limited liability company, a two-tier system is set up. The managers will be like trustees because they are acting in the interest of the members. So what normally happens, they have the guiding document or they have a JD where they agree, these are your responsibilities, these are your targets. You deliver, we pay you. You don't deliver, we review. So that is the arrangement. The responsibility and duties are well documented. Unlike in the other case where we have the equal ownership and the members, you cannot really say that you, as member A, you are the one who will be passing by the building in the morning to ensure that all the tanks have water, or to ensure that all the security lights are turned off. You cannot really allocate a particular duty to someone. But in this case, where it is manager managed, you leave them to run the business for you with well-highlighted targets that they are supposed to deliver and well-highlighted responsibility. So the flexibility of pass-through taxation in a limited liability and management structure have made now LLCs to become very popular when it comes to ownership. And you can see here, we are doing the business, we are doing it very professionally, and it makes a lot of sense. So instead of LLC, it would be easier for us to go for the LLP, where an existing general limited partner is attempting to change form or gain more liability. In some states, changing from a partnership to LLC is very expensive. It's a taxable event. But changing from the LLP is very easy. So as an advice, it will be easier to run an LLP instead of an LLC because this is a body corpora. When we are talking of a body corporate, we mean that we are running this strictly under the well-highlighted guidelines. So we got the articles of association. We have the MOAs that are guiding the operations of this particular business. Any questions so far?
Hello, Mwalimu.
Yes.
Kindly share screen.
I've not shared.
No, you've just been talking and it's blank, so we are just listening.
You've taken too long to respond. But I'm assuming you have these notes, right?
Yes.
Do you read my notes? Let me share the screen. Where did I lose it? I was sharing ab initio from the word go. So we come to the corporations. So I was saying, to wind up, if you are not seeing, this is the most critical area. So when you are doing revision and you don't have time, mahali unaona huyu jamaa amepoint, hapo ndio unajua iko na key. Are we there? So it will make your work very easy to maneuver. But I'm trying to summarize. I'm trying to as much summarize. We have a lot of clutter at the initial stage of the finance units before now we get to the real matter. So I was saying the flexibility of pass-through taxation in limited liability and management structure have made LLC or the limited liability corporation to be popular, especially in this field of owning the commercial investments in real estate. Because the LLP requires the partner to be dedicating some resource and quality time to go and oversee the operations of the property. But here it is professionally managed. The challenge that is there, however, is the conversion. So you can see I'm saying it may take more, it may make more sense to form an LLP instead of an LLC. A limited liability partnership instead of a limited liability corporation. Reason being, if you are trying to change now from a limited liability partnership to an LLC, it is a taxable event, which is very punitive and painful. So the charges involved in converting the LLP to LLC are so high, while changing from the LLP is never taxable. So you really have to think on which form of investment vehicle that you want to. Who is that? So we go on. The next vehicle is corporations, and we have two types. We have the C corporations and we have the S corporations. Now for the C corporation, this is a legal and taxable entity that is owned by one or more shareholders, and it is managed by directors. And in this form, can be a natural person or business entities. To mean, two people can come together and agree to incorporate a company. It becomes a C corporation. Two businesses can come together and say, why don't you go ahead and register a corporation as two different entities? Could be commingled. Commingled to mean a combination of the natural and other business entities. It is much allowed. So C corporation status is granted by different countries. Now the corporation files article of incorporation and the bylaws, or what we call the memorandums of association. So we have the constitution and we have the bylaws that will be guiding the operations of this particular corporation. So they specify the operating rules for that corporation. So the incorporation and the operation of the C corporation is expensive due to the nature or the structure of the organization. So we have that upfront cost that is involved, or the formative costs are relatively higher. And we do also have the operational costs that will involve a lot of reporting. The management reports are supposed to be done either monthly, some quarterly, half annually, others annually. But a C corporation offers limited liability to shareholders. That's a good thing to note. The only disadvantage of a C corporation is that there is no option for pass-through taxation. You have to pay tax. So you'll be doing all your earnings, and just before you declare your dividends, you have to do the deduction of the corporate tax. In our tax system, it is 30%. It was brought down due to Corona to 25%, but basically it is 30. Then you have the S corporations. An S corporation is a legal entity that can be owned either by an individual or a group of investors. So a corporation must elect to be an S corporation at the time of incorporation through the following. The shareholders are not supposed to be more than 100. No corporation as shareholders, unlike in the C corporation. No non-resident alien investors. So this will be strictly for the locals and more than one class of stock. So you cannot start saying that you are going to have the rights issue, the preference shares, you are going to have the ordinary shares, you are going to have redeemable shares. No, you can only have one class of stock, which is ordinary shares. Now, if these requirements are met, now we have the S corporation being now put into operation. And they may be elected to be taxed as a partnership. And by being taxed as a partnership, you just include in your memorandum of association that whatever the income that you are going to earn, it will be distributive. Then after you distribute, each particular person report on their income tax. That is what we mean by S corporation may elect to be taxed as a partnership, where you distribute your income at the end of the period, and then I'm going to reflect my income in my income tax when I'm filing back now to the authority. S corporation status is granted by individual states, and like C corporation, S corporation must file articles of incorporation and bylaws. So we are supposed to call them here articles of association on the AOA. Whereas the bylaws are the MOA. So shift F3. And this is the bylaws are the MOAs, to avoid being international. So the incorporation of an S corporation can be expensive because the organizational fees also that are included, they are so substantial. And the reason why they are very expensive is, we are registering a legal person. We are registering this corporation such that once we file it or once we present the papers to the registrar of companies, we won't again be going there with an addendum to say that we want to withdraw or pull out our MOA and add this. If you know that right now, let's say, for example, you have come together to sell real estate properties. If you know that in future, you might be interested in the real estate investment trust, should be incorporated in the formation document. If that is not possible, then it will force you to open another company when it comes to that time. So you can imagine you have taken a lot of time to build the goodwill, to build the reputation, to build the financial history, And then after like that years, when you are just about to take off, the registrar of companies tells you, no, whatever you are telling us is not in your AOA and MOA. So kindly form another company and put the instructions that you want to be adhered to in that formation. It becomes very challenging. That is why we are taking a lot of time to form. And for this one, you have to involve a CPS or someone who is a certified public secretary or someone who understands the dynamics of forming a legal person. So it can be a good choice for real estate investment, especially because of the pass-through taxation. So as an S corporation, it can be used for ownership of rental real estate when the corporation provides sufficient services. However, when the management of the rental property is passive, it becomes a problem because you might experience what we call vacancy losses. Vacancy losses is to mean I have a building here that has 100 spaces, but out of the 100, only 30 are occupied. So it could be managed by even another person, but am I getting the return for my investment? It becomes a challenge. Any question? The last one is joint ventures before we come to the syndicates. I had talked about the joint tenancy. And in the joint tenancy, I was saying that this is where the property is owned by two people and they have equal shares. To mean they have equal control and no one can come and say that I'm the better or I'm more superior than the other. When we come to the joint ventures, like in the group accounts, we know that when a holding company owns 50% of your shares, it's like you are partnering, so it's a joint venture. If they owe more than 50, sorry, if they owe more than 50, it becomes a subsidiary. If it is less than 50, it is an associate. If it is below 20, it is an investment. Joint ventures are owned by two parties who have a particular objective that they need to achieve. In this particular case, we are talking of real estate investment. Now, joint ventures or JVs can be terminated. So their span, we could be coming together as an investment vehicle. Once we achieve a certain objective, we again part ways and everyone goes back to their business. So they are formed for a duration of time that is well stipulated in the JV agreement. And once the time has elapsed and the objective met, they can just freely leave and go back to their original or normal operations. Now, these are some of the merits. Risk sharing. A single investor may be unwilling to undertake a real estate venture because of its size. Some because of the location, could be it is lying on a very cold market, some hot market. Some is because of the capital requirement and maybe duration. I'll advise you, if you are looking into venturing into a real estate that might require a lot of capital, the best joint venture to go into is a joint venture between you and the financial institution. And this is what is happening. NIC Bank Head, they are now NCBA, where I own the property, the soil. You bring the resources to develop. I can give an example. The prevailing market price of an acre of land in Kitsuru is 800 million. That is the prevailing market price. I'm talking of an acre. So if you have two, that will be 1.6 billion. If you have 3, 2.4. And they are also very particular. You can only own from 3 acres and above to be in that neighborhood. So you can imagine, I have soil that is worth 2.4, but I don't have anything to develop that on that soil. It becomes a big challenge. So I can approach a bank and tell the bank, I have this property that is lying on a hot market in Kisuru suburb, and I want you to develop some properties for me, and then we'll be sharing in the income that I'll be drawing from that particular property. If, for example, they agree and you want to do, let's say, three family houses intending to sell, and let's say one house, you put the cost of the house, let's say, at 50 million. So you require like 150 million to develop the 3 houses. But your property is worth 2.4 billion. Do you think the bank will refuse? The bank will agree, because the risk that they are going to share is by and large. Actually, it is you who is exposed to more risk. It is your property. So risk sharing, a single investor may be unwilling to undertake because of the capital involved, and they don't have that capital. So they can join venture. Then after they achieve, once, let's say, you pay back the 150 million that belong to the bank, the property will revert to you. Then we have the combination of the combining of the expertise with capital. For example, let's say you want to do, you are an architect, and the other person is a real estate specialist. You could come together because of the expertise that you are in. Whereas one will be providing the expertise in the building and the management, you will be bringing in your rich knowledge in the real estate field. So some people will just combine to bring together or to commingle their expertise, and then of course the capital that they are going to draw to drive that investment. Now, in the organizational forms, we say that participants in the JV may include either individual investors, they could be partnerships, they could be corporates, they could be REITs, or what we call the Real Estate Investment Trust. However, a JV on itself is not a legal form of organization. You are just coming together. So whatever you do is what we call a working agreement. Is on order? Did I stop sharing? Did I stop sharing, or someone unmuted yourself? I have like 12 minutes also. So hanging there. So I was talking about the registration of the JV. And I was saying that it is not a legal, it is not a body corporate. So what you are doing is coming together. Very few burdens are heavy when everyone carries. So if you are two, the burden becomes lighter. The investment burden becomes lighter. So the choice of organizational form used to accommodate these various groups of investors could be a partnership, it could be a corporate, could be a real estate investment trust. But once they commingle and come together, we call them a JV, because their purpose is forming this investment vehicle, achieve a particular objective, then revert to their original state. Now, in the profit sharing, because the parties to a joint venture, they contribute different things, and possibly in different proportions, a partnership must be structured such that it provides economic incentives for all the parties. Without the economic incentives, I'm telling you there will be a lot of drawbacks even when you joint venture. It is like saying two institutions come together. Let's say ZTech has a JV with JQuat, and they are doing a scientific research where all the innovations that will be produced will be patented under the two parties. So we are going to have the intellectual property being owned by JQuat and ZTech. And then it happens, JQuat does the donkey work. But you see, when it comes to the intellectual property, which is the output or the end product, ZTech will be featuring there. And they'll have equal ownership in the intellectual property. So we are saying unless we will stipulate and provide the economic incentives that will be going to these parties after their contribution, it can be challenging. So a JV can take a number of different partnership forms, and the most common one is a limited partnership. In this case, all the partners must at least have one general partner, and then we have the limited. And then in real estate, the limited partners are the investors. So they'll be providing most of the equity, while the general partners will be responsible of managing the partnership assets. And they may in some way contribute in small portions, but not equal to the equity that is being given by the limited partners. So limited partners are generally very restricted in the management of the JV, and there is a reason for that. Because their personal liability is limited, hence the term limited partnership. This will be discussed in more details later. So we are coming to JVs and their calculations, so it will be discussed. So what I can say here is when determining how to joint venture, now potential investors will consider the following. One, what is the initial capital that each party need to contribute? Will there be a need of funding in future? Because this will mean that we are going to have now the restructuring of the capital accounts. Now, how will the parties share in the annual cash flows? Let's say I gave 60%. I have another guy who has given 30%, the other one 10%. Now, suppose I give my capital, I'm the one who is giving the largest share, but initially I give 30%. The guy who was giving 30% give the 30%, so it will be equal. But next year, I add 20%. We won't be equal because the cash flows for this year, we were equal. But the cash flows for next year, I expect my proportion to be increased to 0.5 because I'm giving the extra 20 million. So I think you understand. I'm just trying to hypothesize. 3, how will the parties share in the cash flow received from sale of the property? So we have seen they need to share in the capital, cash flow. Now they are sharing in the cash flow. So we have the capital, the cash flow. Now we need now to share the cash flow that is received, or what we call the cash inflow. So we have the cash outflow number 2. Number 3, we have the cash inflow. After now we dispose the property. Will some of the parties receive a preferred return? And will the preferred return be paid from the annual cash flow from the sale? We need to know, because we have limited partners. Now, will taxable income and capital gain be shared in the same proportion that the operating cash flow is distributed? And this is a big question. When I said in the first year, we all give 30-30. But in the second year, I give more. If the property will not be sold in the first year, there is a potential overlap, because in the second year, I expect my cash inflow to be more than in the first year. Whereas in the first year, we receive the same amount. And remember, this is an investment property that we need to dispose sometime in future. So if we dispose it 10 years to come, a lot will have changed. And that's why JVs need a lot of knowledge in the property valuation, and it involves a lot of actuarial science when we are trying now to try and get the IRR, right? So who will have control over the operation of the property? Who will be involved in the decision? You said we have the management, or you have the general partners who are doing partial work of management, and they are tying their quality time in that. And then we have the limited liability partners. So the initial capital, this is the thumb rule. Sorry, now this is the thumb rule. As noted, a JV is often motivated because one party is in a position to invest capital, others contribute expertise. So the investor partner may be a wealthy individual, but they are not professionals in the area. So the money partner is usually more interested in the diversification and usually does not need to have the desire or the expertise. So I brought my money. I want my money to work for me. I don't care what the professional will do, as long as we are able to get the attractive IRR. Now, for example, if the initial capital contribution may be distributed, let's say the money partner contributes 90 to 95 of the equity, and then we have the professional giving 5 to 10%. Even though one partner may be providing the operating expertise, is generally expected to contribute some capital. This is what we call encumbrance in real estate. You are committing. You see, when your money is there, it pinch, especially if the money is not going into the right. So they have in the modeling, it is good to have the expertise at least encumber some amount. This is what we are calling the 5 to 10%. So even though I'm providing the expertise, I have also injected some capital in the business. To mean, I'm also an interested party, I'm an IP. So returns to the developer and the money partner will be aligned to some extent because both have some invested capital at risk if the venture loses. The developer or the operator is applying the day-to-day operational expertise, whereas the money partner gave the initial investment. So this usually pointed out that the developer or the operator make the investment successful. That's why we are asking them to encumber some initial amount. Should be pointed out that the developer who is promoting the project be approaching many money partners in an attempt to find one who is interested. So they are also involved in the marketing job. And all this is involving their quality time. So the relationship between equity contribution, fees, and profit sharing will be completely or competitively driven in the market for equity capital. And you will see that when we come to the calculation of the IRRs of the JVs. So sharing of the cash flow from the operations. So one way to share cash flow is on the net operating income. So that proportion will be on the capital that was invested. Now, for instance, let's say the developer contributed 10%. He will receive 10% of the cash flow. So this is an cumulative distribution, or that name you are seeing there, pari passu. Now of the cash flow. However, if it is more common for the money partners and the operating partners to share in the cash flow, and the property now appreciates, this proportion is not exponential. Now we are going to have the partner who contributed more being a preferred partner because they are going to receive the preferred distribution. In other words, I'm saying, suppose we didn't get the income that we had apportioned to get that year. Consideration will be given to the partner who had contributed more first before we share the other returns. And you will see this. I've given a hypothesis there that investor partners may receive the preferred return calculated on an 8% yield on the initial investment. And consequently, if they invest 1 million in equity as the property, then we are going to apportion. So we'll be getting the 8% of that 1 million. which will give us the 80,000. That is what they are expected to receive from the word go. So after the capital distribution have been made to the investor partners, the developer, who is the operator, will also receive cash equal to the 8% of the initial investment, only for the initial investment. So you can recall when I was talking of, I've given 3 million, another guy has given 3 million. So initially we are going to share the same rate, but subsequently, because my investment is going, this will change. So let me leave that as the hypothesis. So we come to the sharing of the cash flow. You can read, it is in the notes. And I'm seeing this because of the time. We are about to be closed out. So the sharing of the cash flow from sale. So the success of the investment may not be known until the property is actually sold. So we could be doing all this in the JV and trying to apportion first year, second year, and the like. But when it comes to the prevailing market rate, or when we will be disposing, it shocks us. So it needs a lot of calculation to know exactly. It's like when you are doing the calculation for annuities or the net present values, you really want to know whether the discounted cash inflow will give you a return sometime in future, let's say after 35 years to come. So you have to take care of the inflation, you have to take care of the seasonal risks that you are not expecting, all this. Now suppose, let's say your building was on a riparian land. Then just before you sell, the county government of Nairobi declares it on riparian land and the building is brought down. The JV collapses because whatever the contribution and whatever the things, you cannot really call that. So these are the dynamics of the real estate property. Remember, this property is fixed on the fabric of the earth. There is no way I can come, let's say we have 10 floors, and say, I'm tired with this joint venture, so I can just take my 2 floors that are appearing between 5th and 7th floor and leave. Unless you bring the whole building down, will you have the floors? So sharing of the cash flows from the sale becomes very fundamental. So the final distribution of the cash flow from the sales is usually made after repayment of any outstanding debt. So all the obligations are first met, and whatever remains now is usually saved now to be now paid. Who is this? Are we on point of notice? So the remaining cash flow will now, I don't know whether they are emphasizing. So when we are talking of the IRR, is the investment rate of return. So we need to apportion this from the word go. And that's why I'm saying that the calculations need to be done before the commitment of the equity, so that we understand our investment rate of return on the equity invested will be this much when we anticipate to sell this property, let's say, some 20 years to come. If that is not possible today, we are not running any business venture, and we could be at the verge of losing. Any question? Any question? So you have what we are calling the IRR look back. I'll explain this when I'm giving the example. It will be easier portrayed in the example than hypothesis. Any question? Time is gone. You have 1 minute. Question? I go back to the, when I mention your name, you are supposed to respond. Kibibi, any concern? Unmute yourself. Unmute yourself. Should stop sharing.
No concern, I'm good.
Fatimo? If you look at the participant, just unmute yourself. Evelyn?
No.
Jen Namu? Just confirming that we have all the people on board. Jacqueline Ouma? You're good? Jundi
Yeah, I'm good.
Judin Zioka?
I'm good.
John Owino?
I'm good.
Robert Obado, where were you in the morning class? Obado? How are you in the morning class? Obado, we are talking to you. Ogutu Steve?
I'm good.
Juguna Paul?
Yeah, I'm okay.
Babura Veronica?
I'm okay.
Ah, fantastic. So let's go to the portal. Let us interact in the portal. The notes are in the portal. We have a discussion forum in the portal that we need to respond to. And I'll be right in there. So enjoy the rest part of the session. Be blessed.